ACCA spreadsheet then in the CBE exam. First of all, I want to talk about that little format bar at the top, just to make sure that we're comfortable with all of those. So let's go and have a look at that. So here I am, and hopefully you can see this little first button here is the reset button. So if you used to put, I don't know, 12 in there and 12 in there, you think, oh, that's no good. I want to reset everything. You probably won't need to do this in the exam, but if you did, then that's how you would do it. It just sets everything back to normal. There's a little glitch there, and this, the percentage, just brings up the size. Now, let's say you want to cut something. Hopefully you know how to do this, but if you think that 345 is really good, but you want it in a different place, you put scissors and then just paste it into there, and you're done. So cut and paste as normal. Or you might think that 345 is so good you want it twice, so you press copy, that one there, and you just paste it over to there. Now the next button, I've never totally got this to work, maybe because I use a Mac, but basically it paints the format of your cell. So next button, undo. Next button you've already seen me use, different size of screen. I'm going to try and keep it to 200. Next one is your font size. So whatever you want, and then if it gets like that, you can just resize, just like you can in Excel. Double click there, and it will just resize your columns and rows. You can make it bold, underlined, indexed, make it red, whatever color you fancy. Have a bit of fill on. Yeah, looks terrible, but there you go. And let's just see if you want to. There's no marks in the exam, by the way, formatting, but sometimes it's just nice to make things look nice, isn't it? So left, center, and right adjustment. These three seem to take quite a long time to do for some reason. Never quite sure why. I think it's probably because there's a lot for it to go through. And then you'll see these decimal point ones. So that's 2 decimal points. So if you want something to do 2 decimal points, you hit that one. No decimal points, but with a comma for your thousands, you put that one. If you want thousands and decimal points, want to be greedy, you use that one. Okay, hopefully everybody's following this. I can't see it, so I don't know. Currencies, bit technical that one, but $, red for negatives. Percentages, do you want 2 decimal points or 1? And that's about it really. The other one's fractions and times of the day. Right, I don't want it to look like that. I want to get it all back to normal, so I'm going to hit this reset button. So reset it, sets everything back to normal. Little bit of a glitch there, and we go to 200%. Okay, off we go then with the actual presentation. So we've done that, and now I want us to think about net present value. So if you're doing FM or AFM, this can be really important to you. So here we have then some net present value, sales of 100 in year 1, and then you've got a 3-year project. But it says sales inflation is 10%, but they haven't been inflated yet. So you've got to put the inflation into year 1. So 100 times by 10% is 10. Add that on to get to 110. Then an extra 10%. 10% of 110 is 121. Is 12. Add it on. 11. Add it on. 121. Next 10% of 121 is 12.1. Add it on, like so. Okay. So that's what we need to be able to do in the exam. Let's try and see if we can do this then here. So I'm going to put year 0, 1, 2, 3. I'm going to put my sales in. And I said sales here were 100. I'm going to put it as a formula. 100. So equals, showing it's a formula. Now I want to increase it by 1.10. Okay, that's adding 10% on. And because I want to put the inflation in this year, this is the first year's inflation, so I do it to the power of 1. Give me 1 year's inflation. Okay, so we put that in, magic. And then if you get that little cross there and just drag it across, that will put the inflation in for years 2 and 3. And everybody's a winner. Okay, hopefully we are all okay with that. Let's move on then. So what would happen then? So that's what we've got. what would happen if it was already inflated in year one? So you don't have to do year one because year one's already inflated. The examiner might tell you that. In which case, year two becomes 110 and year three becomes 121. How do we put that into our little spreadsheet? Well, this 110 here, I don't need to do that, do I? It's just 100. This is 100 times by 1.1 to the power of, because it's only had 1 year's, to the power of is the little sign above number 6, by the way, to the power of 1, it's only been 1 year, and then it'll all work for you, like so. Okay, so that is how we do that. Hopefully we're all good. Right. Now, cost inflation, let's do that then. It's 20%, but it's already been inflated in year one. So 20 is already done, and it's 20% inflation. 20% of 20 is 4, so that should be 24 in year two. 20% of 24 is 4.8, add that on, so it should be 28.8. Let's make sure we're good at this then, and go and put that in our cost of sales. So our costs. So it was 20, I think. And then I want that times by 1.1 to the power of just 1 year. I do that because then I can just drag it across. And obviously, the longer it is, the better it is. And I put in 0.1 of an I, and it should have been 0.2. 20% inflation, wasn't it? So yeah, wait for that little cross. And what have I done there? D3 times 1. Sorry. That should be 100 minus 20 times by 1.1, 1.2 to the power of 2, shouldn't it? Okay, and that's how you would do that. And obviously, the better this is, you know, if this was a big one, if this was 5 years, obviously it's really useful for you putting in these little formulas. Okay. Right, that's that. Now, let's carry on. So, we've done that. Then we get told tax is 20%, but payable in arrears. Now, obviously, you get taxed on your profits. So, in year one, well, first of all, it's payable in arrears. So, year one's tax would be payable in year two. Okay, so year one's tax, it's a profit of 80, should be payable in year two. Okay. So, that tax then, because it's payable in arrears, year one will be payable in year two will be payable in year three will be payable in year 4. And so, therefore, we need a 4th year, but only for the tax. It's still a 3-year project. So, let's have a look at the profits. 100 minus 20, obviously, is 80, times by 20%, 80 times by 20%, 60. That goes in year two. Happy. Year two, 110 minus 24. That's the profit. Times by tax rate, 20%, goes into year three because it's in arrears. And finally, year four's 121 minus 28.8. That gives you your profit, times by 20%, 18.44. So that's how it should be done. Let's go and do it. So, tax then equals sum of, in brackets, those two. That, colon, that. Times by minus 20%. Why did I put a minus? Because it's an expense, okay? Now, that minus 16 is in the wrong year, isn't it? It's payable in arrears, so it needs to be moved. You can move it just by waiting for that little cross there and drag it across. Nice and straightforward. Let's do the next one then. Equals the sum of that to that times by, if you remember, minus 0.2, 20%. We've done, and you could just copy the next one across. Okay, hopefully we are all happy with that. All right, So that's the tax bit done. So you do the tax worked on your profits, make sure you get the negatives right, and we're on our way. Right, now you get told the investment is 80 and the residual value is 20. All right, investment 80, residual value 20. So the investment goes in year 0, minus 80. And the 20, be careful, goes in year 3, not year 4. Year 4 is just for the tax, okay? And that is that. Now, I'm just going to make it look a bit better. So in that column, I'm going to make it bold. In that row, I'm going to make it bold as well. It might take a little bit of time. There we go. Okay, so we've done that. 80, 20. Next, we get told now do the NPV then, if your discount rate, if your cost of capital is 10%. So here we go. Here's the clever little bit. First of all, I want you to write in your cash flows. Your cash flows, year 0, sum from all the way to the top, sorry, there, colon to where you want to go to, finish your bracket, done. And once you've done one, you've obviously done all the rest. Okay, so I've just summed up all my cash flows. You have to do that first. Now I want my discounted cash flows. Okay, and I'm going to make it bigger, fit it in the cell by just going up there and double clicking. Now, my discounted cash flows, pay attention to this, equals NPV. That's your formula. And the first part of an NPV formula, it needs to know what's your rate, what's your cost of capital. And if you remember, I think I said was 10%, so 0.1, okay, comma. So you've told the formula, you've told the computer, look, I want the NPV, but it's 10%. Now, the computer's saying, yeah, but on what? And this is the key bit. You say, right, from year 1, all the cash flows from year 1, all the way across to year 4, to the end. But notice I've missed out year 0. It's just something you have to do. So it's rate, cash flows. And what it's done then is discounted all those 4 down to cash flows, to 10% cash flows. And you'll see you get this gobbledygook figure. That's okay. Now I go to my little decimal points here, and I'll have it to 2 decimal points, 189.36. But my NPV, my net present value, includes year 0. So my NPV is the sum of year 0's total and the discounted cash flows of it afterwards. Gobbledygook, get to the decimal points and put it in. And my NPV then, I'm going to make it red because I'm so happy with it. 109.36. All right, tricky, but not bad. Let's go and have a look how that would have worked then. Let's have a remind ourselves. So I said, first of all, you need to calculate your cash flows, just your normal cash flows. Just sum them up using the sum formula, 80, 80, 70, 95, and 18.44. Once you've done that, you now need to calculate your discounted cash flows, discounting them down at the cost of capital. And the cost of capital was told to me to be 10%. So calculate your discounted cash flows. Where you do it, you put in that formula. NPV, open your bracket, 10%, your cost of capital, comma, your cash flows. Can you remember what cash flows they were? Did they include year 0? Hopefully you're all telling me, no, they didn't include year 0, 1 to the end. Okay, that would give you all your discounted cash flows from year 1 to the end. So to actually calculate the NPV, you then need to take off year 0, because we've ignored year 0 so far. So finally, you take off year 0, the 80, and you get your NPV of 109.36. Okay, all happy with that, I hope. A little bit tricky, but you know, it saves so much time compared to doing all this by hand. Right, so that's NPV. Now let's think about the internal rate of return. So in that one, we discounted it down at 10%, but it was still a big positive NPV. So the actual rate it was given us must have been far more than 10. IRR tells us how much more it is than 10%. All right, so let's have a look. IRR, baby, this is what we do. You use an IRR function, and all you put in is cash flows. So none of this guess at one level, guess at another, blah, 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 blah. All you do is just do that lovely little function there. So let's go and do that lovely little function there then. So IRR. If the question asks for the IRR, you'd say, right, I want the IRR formula, open my bracket, put in the cash flows. But look, the cash flows this time do include year zero. I want that all the way to the end, close my brackets, done. IRR is always as a percentage, so just turn it into percentage. I'll have it to 2 decimal points, 80.81, and because I'm so happy with myself, I'm going to make this orange. Okay, so that is that. All right, really simple and straightforward. I'll be coming back to IRR a little bit later as well. Okay, right, all still with me. So we've done IRR. Now, those IRR cash flows did include year zero. So all you do is put all of them into your IRR. Easy. Let's see where we are then. Let's take a deep breath and see where we are. We did IRR cash flows. Did we include year zero in there? Hopefully you're saying, yes, Richard, we did include year zero. And then before we did the IRR cash flows, we did the NPV. And the NPV formula was equals NPV, open bracket, cost of capital, 0.1, whatever it might be, comma, cash flows. But in those cash flows, did we include year zero? No, we didn't. Okay, not in that formula. That just gives you the discounted cash flows. To actually get to the NPV, you then needed to deduct year zero. Okay, so that's how you would do them. Right. All still with me? I'll take a drink of water. Let's now have a look at modified internal rate of return. Now, modified internal rate of return solves the following problem. When we did that last IRR of 80-odd%, it presumed that all the inflows could be reinvested at 80%, which is highly, highly unlikely. They probably can't. They probably can be reinvested at the cost of capital. So that's kind of what the MIRR does. All right. So the MIRR formula, you put your cash flows in, same as IRR, include year zero. Then you put the cost of capital in. That's just saying to it, discount it down at the cost of capital, please. And then you put the cost of capital in again, if not told otherwise, because you said, right, this is what it can reinvest in. So it's cash flows, including year zero, cost of capital, because that's what you can discount down at, and then cost of capital again, because that's what you can reinvest at. All right, so there's three things. Cash flows, what can you finance at? Normally cost of capital. What can you reinvest at? Unless told otherwise, that's going to be the cost of capital again. But if you do get told you can reinvest at a different figure, then you would do this, wouldn't you? You'd do cash flows, discount it down at cost of capital, but reinvest at the higher figure. Okay. If you don't get told the reinvestment rate, though, just use cost of capital twice. All right. So a little bit trickier, you know, a little bit further on now. So more AFM sort of stuff. So going back to this then, all we need to do here, it tells us the cost of capital was 10%. I knew that anyway. But the reinvestment rate was 20%. So let's go do that then. So cost of capital 10, reinvestment 20. All right. So I'm going to do the MIRR equals, can you remember, you do the cash flows. So the cash flows are from there all the way to the end. Just like IRR, you include all the cash flows, comma. I forgot to put the MIRR in. Needs to know what we're doing, doesn't it? Comma, cost of capital, 0.1. And then, unless you were told otherwise, you'd put 0.1 again. But I was told otherwise. I was told I could reinvest at 0.2. Close it down, and you've got gobbledygook, turn it into a percentage with maybe 2 decimal places. Everybody's happy, and I'm going to make that, oh, I don't know, a light blue. All right, so we've learned NPV, IRR, MIRR, and we've only been going for 20 minutes. So hopefully you're all happy with that and you understand everything. If not, I'm here to help because we're going to do a little recap. So MIRR, cash flows, 0.1, 0.2, that would do it. And you should get 39.74. And when I was doing it live, that's what we got. So we're happy. Let's recap it all then. IRR, you just put the cash flows in. Okay, simple as that. Do you include year zero? Yes, you do. If you're doing the NPV, first of all, you need to work out the discounted cash flows. So you put in your rate, your cost of capital. Then you put in your cash flows. Those cash flows, do you include year zero in an NPV one? Not including year zero in that NPV formula. But you do include it when you come to finally say, this is my NPV then. You just take off year zero and that's your NPV. MIRR, cash flows, cost of capital, reinvestment rate. If the reinvestment rate is different to the cost of capital. If they're the same, just put it in. Just put 2 lots of cost of capital in. What about the cash flows? Did you include year zero? Yes, we do. MIRR is just like IRR. You do use the cash flows. Okay. All good so far, I hope. Just checking. Yeah, all right, cool. Now let's talk about the learning curve then, learning curve. So how about this little example? We're making something, you know, something that's labour intensive, not done by a machine, so something we can get better at. And we're saying that the first one took us 12 hours, but there is a learning curve, i.e., as you double the amount you make it 75% in this case better. So you're learning quickly. All right, so how long would it take you? If the first one took 12 hours and there's a learning curve of 75%, how long would it take you to make the 8th? Not how long does it take you to make 8 items, but how long does it take you to make the 8th item? Right. So how long to make the 8th item? Right. So what this is actually saying then, the way to work out the 8th item is to work out the total time to make 8, less the total time to make 7, and that should be the time for the 8th, shouldn't it? So how do we work out the total time for the 8 items? Well, the way you have to do it, you have to say, what was the average time per unit when we were making 8? Because the average time per unit includes all the learning that we've done. And that, because that was the average time per unit, then total it by times it by 8. And you have to do the same for total time for 7 items. What was the average time per unit when we were making 7? And then times that by 7 to get the total. Now, the reason we have to do it like this is because we can work out the average time per unit with a nice little formula. Y is the average time per unit equals A, which is the first, how long it took you to the first one, times by X, which is the number of units, to the power of B, which I'll show you in a minute. So this is how you work out the average time per unit. You take 12A, the first, how long it took you to do the first one, times by 8 in this case, because it's 8 units, to the power of B. Over to the 7, if I was doing the 7, it'd be 12 times 7 to the power of B. Are we all with me? Okay. The question is, well, what's B? And B is this log R log 2. Okay, so quite tricky. You know, I'm not trying to make things easy. I'm trying to show you exactly what it would be like in the exam. So let's see if I can do this. I might get it wrong. It's quite tricky. So first of all, I'm going to reset everything. So there we go. You probably won't have to do that in your exam because you'll be using a new spreadsheet as the question changes. Right, so what I want is here, I'm going to call it average time per unit. Nice and big. Average time for 8. And then I can put my total time here then. And then I'm going to have one for 7. And I want to know what B is. So I'm going to call this the learning curve. So if you remember, the way you work that out is log, then in brackets, then your learning curve, 0.75 I said in this question, divided by log in brackets 2. Simple as that. Okay, so like so. So the average time per unit is A, how long it took you to do the first, times by 8, that's how many units, to the power of B. Okay, and I don't know if that's going to mess things up, so just to be safe, I'm going to put that in brackets like so. Do the 7 one again. So this is the average time per unit to make 7. A, 12, times by 7 to the power of B. Okay, I'm going to drag that down to 2 decimal places, and then I'm going to say, right, the total time then to make 8, if that was the average time per unit, total time to make 8 is that. And I'm going to do the same there. If that's the average time per unit, the total time is to do that, as we've done there. Okay, and so the total time to make the 8th must be that. If that took us 8, total of 8, total of 7, total time to make the 8th was that. Bring it down to 2 decimal places, and I'm done. Okay, so quite tricky, but let's just check again. Average time per unit, Y, 12, times by 8, the number, to the power of B. How did I work out this B? I'll just do it again here. Log R, 0.75. You were told the learning rate, comma, divided by log, in brackets, 2. Okay, that's how you worked out B. So let's go back then and make sure that we're happy. Did IRR, we did all the cash flows, didn't we? Did we include year 0 in those? Yes, we did. So IRR cash flows, easy. When you're doing NPV, you put the rate in because it doesn't know the rate, it doesn't know the cost of capital. Then you put your cash flows in. Do those cash flows include year 0? No, they don't. And so therefore, when you come to do your NPV, you just take off year 0. And you're done. Then we said, right, let's have a look at MIRR. Cash flows, discounted down the cost of capital, reinvested, maybe at a different rate, okay? And in those cash flows, did we include year 0? Yes, we did. MIRR is the same as IRR. Then we looked at the learning curve. And to work out the average time per unit, you do Y equals A times X to the power of B, where A is the time for the first one, given to you, times by the number of items given to you, to the power of B. So the only difficulty really is working out, well, how do you calculate B? Can you remember what formula you use? Equals log, in brackets R, so 0.75 in our example, divided by log, in brackets 2. All right, so that's the learning curve. Now let's have a look at a bit of weighted average cost of capital and how the spreadsheet can help us with that, if you still have the will to live out there in computer land. Okay, so weighted average cost of capital. Here's your little template that you'd always do, okay? I've simplified it a little bit, but not much. So you've got 3 types of capital: ordinary shares, bank loan, and a redeemable loan. Okay, market value then, given for ordinary shares, let's say 100, and let's say that the cost of equity was given, shares, equity, using CAPM or something, you got it to 10%. So the weighted average cost of capital then, 100 times 10% is 10. I'm not going into that. That's not what I'm trying to show you here. Right, now bank loan. Book value same as market value, so let's say that was 100. Now, the cost, you might think is 6%, but it's not necessarily 6% because there might be some tax involved. So let's say tax is 20%. Now, because you pay interest on a bank loan, that reduces your tax bill. So you get some tax saving. So the cost to you isn't 6%. It's 6% times by 80%. Now, where did I get the 80% from? I'm sure some of you know. 1 minus the tax rate. 1 minus 20% is 80%. So the actual cost to us is 4.8%. So that's the only trick really for bank loans. Nice and easy. Just tax adjust it. Multiply it by 1 minus the tax rate. Okay, so 4.8%, 100 times by 4.8 is 4.8. Now, again, easy. This is the tricky one. This, prior to the spreadsheet being available, when I used to have to teach this in class, I used to think, oh my word, this is going to be a long, drawn-out process. It's now really simple, thanks to the ACCA's wonderful spreadsheet. So let's say the market value is 110. It's always given per 100. So let's say it's 110. And let's also say that this redeemable loan is a 5-year redeemable loan. So just remember these figures, because I'm going to flick over now to the spreadsheet. It's 10% cost. It's 5 years. The market value is 110. The tax rate is 20%. We've got quite a bit to remember, but I'll do my best. So here we go. I'm going to clear the spreadsheet again. I'm going to make it 200% again. This is just a little glitch. I don't quite know why it does that. Okay, so what you've got to do is you've got to put in here all of your cash flows in the future. All right, simple as that. And you're going to start at year 0, and this was a 5-year thing. By the way, you can, if you get that, it's just a little bit of a shortening, you can then just copy that over like so. Okay. I'm just thinking whether I want it that way or not, or shall I do it the other way? I think I'll do it the other way for you, it'd be easier. One, two, three, four, five. Obviously, you could copy it down. Now, this is the tricky bit then. So in year 0, you always put as a negative, because that's what you can buy it for, the market value. Okay, so we'll always put that in. So minus the market value. Then you've got to work out your interest. Now, and it's always interest based upon 100. This is all per 100 of debt. Now, can you remember the interest was 10? So you would think that, well, it's 10% times 100 is 10. But it's not, because tax relief. Okay, so what it is actually is 100 times by 1 minus the tax percentage, which was 0.2, wasn't it? So and the interest would have been times by 10%, wouldn't it? Times by 1 minus 0.2. Okay. To be honest, I made that a lot more tricky than it actually is. It's 10% of 100, which is 10, times by 1 minus the tax rate. So taking off the 20%, so times by 80% to get to 8. It's even easier to do it in your head. It sounds more difficult when I'm saying it, to be honest. Okay, but just so you're clear on that, 10% here, 20% there, so that would be 8%, wasn't it? 10% times by 80% is 8%. Okay, and that would be the same for, wait till you get to the little cross there, copy that down. That would be the same for all those years. And you'll also have to pay the interest in year 5 as well. But in year 5, you have to also pay back the capital, the nominal value. So the nominal value is 100, but you also have to pay the interest, so it's 108. So you do it like that, okay? So in here was capital, interest. Now, there might be in the question, it might say there's a premium on redemption. Now, if there was a premium on redemption, you'd put it in here as well. If it said there was a premium on redemption of 10%, you'd put an extra 10 here. Okay, there wasn't in this question. Right, the question is, what's the cost of debt for this redeemable debt? And the way you do it, you go equals IRR. Do you include year 0? Yes, you do. All the way down to there, just put them all in, and you've done it. That is it, my friends. I want that actually. Let me just put that in again. Equals IRR from there, from the year 0 all the way down. And I'm trying to get that to not be a number, to not be that. I want it to be a percentage. That's it, 5.65%. Okay, and that's how you would calculate that. So let's put all that together then. So we had ordinary shares. We had 100 of them, market value. I think we said the cost of equity was 10%. So that is that times by that 10. And then we had a bank loan of 100, and we worked out that the cost of debt for the bank loan was 4.8%. So I can just bring that down. Wait for it to turn to a little cross, drag it down. And then finally we had this redeemable loan, 110. Always put, this is always the market value, not the book value. Okay, that was that 5.65 that I've just worked out there. Let's just change that to percentage again. And then I can just copy that down. And let me change that to a nice number, like so. Okay, then we can sum these up. So all my capital market value was that down to that. All my costs was that down to that. To gobbledygook numbers, just go to your decimal points. Say, look, I only want this to 2 decimal points. My weighted average cost of capital then is that divided by that. Okay, and that wants to be as a percentage. Done that. Show off, make it red. Okay, so that is that. Let's go and see then where we are. Let's recap ourselves a little bit. So that's what I've been doing with you. We got it to 5.65%. We multiplied it across. Then you add them down, and then you divide one by the other, and you get your weighted average cost of capital. All right. So again, the spreadsheet should really, really help. So make sure you practice this on the ACCA platform. So recap, should be getting good at this now. IRR, cash flows, do you include year 0? Yes, you do. MPV, first of all, put the rate in, then do the cash flows. When you do the cash flows, do you include year 0? No, you don't. And because you don't, when you come to calculate your MPV at the end, you have to deduct year 0 to get to it. When you're doing MIRR, you take your cash flows, you discount it down the cost of capital, then you put in your reinvestment rates. Do you include year 0 in those cash flows? Yes, you do, because it's just like IRR, MIRR, IRR. Then we looked at the learning curve. Can you remember what Y was? The average time to make a unit. And the way you calculate that is the time for the first one times by the number of units to the power of B. But can you remember what B was? What formula we used? Equals log in brackets, the rate, 0.75, whatever it might be, divided by log in brackets 2. And then what we just went and did was, how do you calculate the cost of debt? That says irredeemable loan. That should say redeemable loan. My apologies. That should say redeemable loan. And you do it like this, okay? So let's have a look. That should say redeemable loan as well. You start off year 1 with a market value as a negative. Then you put the interest in, tax deducted, as positives. And then at the very end, you put in your 100 as a positive that you have to pay back, your interest that you have to pay back, just the nominal value, not your market value, plus, remember, any premium on redemption too, okay? So work all that out. Once you do that, then you do a simple IRR calculation, which is why it says irredeemable loan there. I was getting confused. You just do a simple IRR calculation on it, and you're done. Right, moving on then now to uncertainty. This little max and min that we can do. I'm going to do min, I think, actually. Have a look at this. When you've got some uncertainty, So we don't know how many we could sell because it's uncertain. So let's say you could make 200. We know that. You can make as many as you wish. Make 200. But the demand, what we could sell, could either be 200, 280 or 350. We're not sure. It depends whether it's a sunny day or not. Okay. So therefore, obviously what we could do is make 280 then, just in case sales were 280. But the sales could be 200, 280, 350. So again, we think to ourselves, well, I might make 350 then. I might really go for it because the sales might be 200 and 280. The sales might be 350. Okay, so that's the uncertainty. So I could make 200, 280 or 350, and I could have all these different demands. So I've got all of this to worry about. Now, in the olden days, you'd have to then say to yourself, right, okay, let me go through all of these individually. If I made 200 and I could sell 200, that's what my demand actually was, then obviously the actual sales I'd make was 200. But what about the next case? I made 200, but my demand was 280 as it turned out. I can only sell what I've made. What about the next one? I've made 200, but demand actually turned out to be 350. I can only sell what I've made. Let's have a look at the next one. You've made 280, but unfortunately demand was only 200. How many could you sell? 200. This time you've made 280. You could sell 280. How many are you actually going to sell? 280. Next one, you've made 280. You could sell 350, but you've only made 280. Next one, you've made 350, but demand was only 200. You can only sell 200 then. Next one, you've made 350. You could sell 280. Therefore, you can only sell 280. And then the last one, you made 350, demand was 350, you could sell 350. Now that's a long process, as you can probably tell. I can now make that a lot easier for you, really. So let's go and make that a lot easier. Let me reset all that. Let's go down from 100% to 200%. And we had make and demand, didn't we? So make was either 200, so I can drag that down 3 times, or I can make 280. All of this obviously would be given to you in the question, or you could make 350. And demand would either be 200, 280, or 350. And again, the great news is what you can do here, go copy it. Just go to the first cell where you need it, paste it. First cell where you need it, paste it. Done. Now, what would my sales be? Easy. It's always the lower of those two. So we're going to use the min function because it's always the lower of what you could make and what the demand would be. So you just tell the computer, tell the spreadsheet, I want the minimum of that, colon, that. Just want the minimum of them. Perfect. Okay. And once I've done that, I can just drag all of that down. I need to get to small x, small cross. Let me undo that because I struggle a bit there. Yeah, drag that down. And there are your sales. So your revenue, example, would be that times by the selling price. Let's say the selling price was 10 and you've got all your revenue all done for you. Let's say that your variable costs were 4. So it would be what your actual sales were times by minus 4 because it's a cost. Drag all that down. And so on and so forth, you know, and then you could work out what your potential profit would be equals the sum of my revenue. I don't know what I did there, equals the sum of, oh, I'm losing the will to live, sum of that and that. And there's my different profits. And you might get asked to say, right, what's the expected values? Because they might give you some percentages on this. Could be whatever, but you can see how the spreadsheet would really help with that just by using the min function, because it's the minimum demand all the time. You could use a maximum function as well when you go on to do maxi-min and things like that. So that is that. Right, IRR cash flows. Please get this right. Do you include year zero? Yes, you do. NPV, put the rate in, then put the cash flows. Do you include year zero? Not to begin with, but then you take off year zero and you get your NPV. MIRR, cash flows, cost of capital, reinvestment rate. Do you include year zero? Yes, you do. Then we went on to that. Can you remember what Y was? Y was the average time per unit, and you work it out as A times X to the power of B, where A is the time for the first one, X is the number of items, to the power of B. How do you calculate B? How do you calculate this? You need the formula equals log, in brackets, whatever it is, 0.8, 0.75, divided by log 2. Always log 2, remember to put it in brackets. Then we did the cost of debt, and my apologies, that should say redeemable loan, and we need to put that in, don't we? So year 1 is a negative, whatever the market value is. Year 2 and 3 and 4 and 5, whatever, is the interest, and then the final year as a positive capital, plus any interest payable, plus any premium on redemption. And that would also work for convertible loans as well. The figure at the end would show either the nominal value of capital or what the share should be worth at the end. So that will all work for any redeemable loan, including a convertible one. Okay. And then finally, we did that, didn't we? If you want to work out the minimum of something, just put equals minimum in brackets, the values, all right? So we've really got through quite a lot today, but I thought I'd add in a little bit more. For those of you who are super technical and are using AFM, Black-Scholes option pricing model, used to be feared throughout ACCA land, really, when this came up. Let me just explain the basic idea of it. The idea then is that you get given the option to buy a share or to buy an asset, okay, sometime in the future. So you've got the option to buy a share or an asset, you get offered the option, you don't have to take it. Sometime in the future, it says, look, you can buy this share asset at an exercise price, that's sometime in the future. And what the Black-Scholes model said was, well, we can calculate how much that option is worth to you. And the way you could calculate it was by knowing what the value of the share is now, knowing how long it was before the exercise price, or before the exercise took place, knowing what the exercise price is, you would know all these, knowing what the volatility of the share is, given by a standard deviation, 25% in this case, and finally, by knowing what the risk-free rate is, because if you're going to buy an option now, you want to at least get the risk-free rate. So can you see that there are actually, when you come to do the Black-Scholes option pricing model, there's 5 variables. There's how much is the share that you're looking to have an option on, how much is it worth now, okay? That's what we call PA, how much is it worth now. How much is it exercise price for? That's what we call PE. The risk-free rate is given by R. The time is always in years, T. And S is the volatility of the share, the standard deviation. So we've got 10 for PA, 14 for PE, 2 years for time, S, volatility of shares, and R, the risk-free rate. So let's see if I can go and put all that in. So what I'm going to do now is, like, if you're doing AFM, there's now this BSOP calculator. Look at this little beauty. Okay, so let me make it 200% so you have a chance of seeing it. Just fill in these figures. PA was 10, I think. PE was 14. Risk-free rate was 0.05, 5%. Time was 2 years. And the standard deviation was 25%. Okay, you do all that, and then it's this C figure here. That 0.59, that is the value of the option. So it's really, really simple now. So if you ask to calculate the value of an option using Black-Scholes, could be on a share, could be on assets, could be on anything, then yeah, that's what you do. You put in what's the price of the asset or the share now. That could be, by the way, that could be, instead of giving you it could be like a business and you'd have to work out what its future cash flows are. So it could be that. So what's the price of the future cash flows now? What's the price that you've been offered it at, the exercise price? What's the risk-free rate? What's the time, always in years? And how volatile is this share, is this asset? What's the standard deviation of the cash flows given as a percentage? Do all of that, and that little magical C there is the value of your option. Okay, and that, my friends, is that. I think we just needed those and we're done. So you will get an email with your chance to watch this again, should you wish, and should you have missed anything, which I'm sure you have. I had a lot to get through. You can come and join us at accountancy.com, where I teach all the ACCA papers, and you can also join our Facebook group. Okay, just by scanning that little thing there, put your camera on and scan that photo there, and it will take you to accountancy and to our Facebook group, which has 21,100 members. And we try and really help. Everybody helps each other out there, so it's a really good, useful resource. Okay, and I think that